Welcome back to the Epic Web3 podcast. I'm your host, Alex. As always, we're here today with Andy from the Rollup, and our guest today is José from Delphi Labs. Hi, José. How's it going?
Hey guys, good to be here. Thanks for having me.
Yeah, thanks for joining. So, first of all, to start, can you briefly tell us what Delphi Labs is today? Because I think you started as a you go on.
Yeah, for sure. I'm one of the co-founders at Delphi. Delphi Labs is one of three kind of main business lines or entities of Delphi. We have Delphi Research, which is like the original, the OG entity where we do write reports and produce institutional grade research for our subscribers. Then we have Delphi Ventures, which is our fund. We now have two funds, and it's primarily internal capital, about 90% our own money. We've made over like 150 investments and are pretty well known there. And then Delphi Labs started off as our consulting arm in sort of 2019 to pay the bills, and ended up working with a lot of really good projects doing that, like Compound, Axie Infinity, Balancer, Synthetics, Aave, a bunch of top projects in the space. And then at some point decided that we wanted to actually get our hands dirty and build our own stuff from scratch. And so that's kind of brought us to where we are today, where we're an incubator. You can think of us as an incubator or a venture studio. All the learnings from and alpha from Delphi Research, all the deals we see through ventures, trying to figure out where the gaps are, the things that are important in the space that no one's building, and then building those.
Yeah, awesome. Yeah, thanks. Thanks for that. So I think your story, like Delphi story, is quite inspiring. So I mean, you started from scratch and build a big company, big group. So can you tell how did you start? What was the first? How did you earn first money? So can you
Yeah,
just tell a little bit about this?
yeah, for sure. Delphi started off as a research company, so just kind of doing that. And obviously we built like a pretty good reputation doing that. Had some great calls, some good reports. Like one of them was our ETH 2.0 report, where we like criticized the ETH 2.0 token economics. Ended up speaking to Vitalik, and like ETH Foundation ended up changing the economics based on that report. And then wrote a lot of other like epic reports. I guess Ventures was our when we started, that was our big win. We started that in December 2019. We actually spent like a year trying to raise money in the bear market, and it was pretty brutal. I was traveling around the world, meeting with all sorts of like unsavory characters. Yeah, it's some pretty wild stories from that time. But pretty much no one wanted to give us money, at least not in a legal way. Like one guy offered us like a suitcase of cash, but we couldn't. Yeah, we were like, we have to do KYC, sir. Like and we were like, we have to know source of funds and this stuff. And he's like, why you need to know this? We were like, fuck. Yeah. So we ended up, yeah. So, I mean, at some point, honestly, that was early on. And at some point we were like, should we just take the suitcase of cash? Like, this is the, you know what I mean? We'll find a way to, yeah. But we
I
didn't end
suppose
up
it was
doing that.
rather tempting. Yeah.
Yeah. So we ended up not raising any money, and that was the best thing that could have happened to us because we basically went all in. So we between us seven co-founders, we put in about $1 million, and it was all in on Thorchain, on Rune, which was like the project we were very bullish about. We just written a report on it. At around I think the 7 cent mark or so, and then basically the entire fund one was us just selling Rune to buy other stuff. So we sold Rune, and then our second investment was we led the Axie seed raise, which was obviously ended up being a pretty good one. And then we did a bunch of good investments, like DYDX, Solana, like Layer Zero, sort of like AVAC, Celestia. We did say like we did a good job there, and so we ended up not having to raise external capital, and Fund Two ended up just being us like recycling the gains from Fund One into Fund Two, and it was like us seven plus some employees, like 30 or so like Delphi employees that also invested, and then like a few select kind of external investors that we think are value add. And that's basically the goal from now on, is just to keep doing that for all the funds. Like if we don't need external LPs, then we'd rather just manage our own money, have like gives us a lot of flexibility. Like we've done tickets as small as 100K for deals we really like at very early stage, and as large as 10 million for bigger deals. So and it's also like just nice managing your own money. You don't have to deal with LPs and all the hassle that comes with that. So and you get 100% of your performance, right, rather than 20%. So yeah, that's probably, yeah, it was a crazy story how we got there, and obviously like but yeah, that was probably our biggest.
Yeah, nice. Sounds
Nice.
nice.
Talking about some of the private market stuff now, how are you kind of thinking about it now? I saw a tweet about the FDV meme, how FDV is a meme, kind of, and how you guys are thinking about that. So from the private scale, like I think the tweet was like, "Oh, people are going to get wrecked. FDV is not a meme." How are you thinking about the private markets now? How are you guys investing? What's your thesis? Kind of like in yeah, what was that tweet about?
Yeah, we're very bullish on the private markets in general. Like that's where we do most of our work. Our thesis, I mean, I'd say we've been most active in DeFi, infra, and gaming. Like those are we're all big gamers. Like some of us are like really big. Like Jan, who's one of our partners at Ventures, he's like really good at. He's been like Pokemon Go. He was like the gym master at Grand Central Station for ages. Like he was fucking running like 10 miles a day all around New York, like grinding that game. And he's been like Piers, who's our gaming partner, was like top 50 in the world at Rainbow Six. So like we're big into games. So that's an area we've always focused on. DeFi came naturally because a lot of the team comes from TradFi, and we kind of instantly understood like the value prop of like censorship resistant decentralized financial rails. And then infra, like we just think of it as the infra that's needed to deliver like these applications, both DeFi, gaming, and like social and everything else at scale. And so we started investing in that very early on. Um, yeah, and our thesis is basically just like good teams tackling like problems that we think are important. Like it's very, I wouldn't say we have like a very well defined like or specific thesis. Where we're just looking for, yeah, like because I also think things change so fast in this space that it's sort of a trap to have that. We definitely have like a vision of what the world looks like sort of 5-10 years from now when crypto wins, like at the end game, like what the world looks like, and we can see all the missing pieces, and we're get us there. um and then in terms of FDV, yeah, I mean, I think FDV is definitely not a meme. People will find that out. It's just that it's very hard to compare FDVs apples to apples. That was like the main point of the tweet, that it's a number, and so people compare them numbers to each other and think that they mean the same things, but they're really like completely different from each other. Like one FDV might be a project that has 80% of its tokens in its treasury controlled by token holders, right? And another FDV might be they sold 80% of tokens to investors and insiders who are up like 1,000x, right? And those lead to like very different like market structures and dynamics. And so like in the tweet, I was just like I mean, you can do more in-depth um, sort of layered analysis, but the basic thing of the tweet was just like a very simple metric is how much of the project's FDV is unrealized gains for someone, right? And the heavier the ratio of unrealized gains to FDV, the worse, like the heavier that FDV is, right? Like if there's a $10 billion FDV and there's like $6 billion of gains for team and investors that are going to unlock, like that's pretty heavy. And there are some projects in that situation, and some in like worse ones. Um, and of course, like that on its own is not enough. Like you need to know who the investors are. Like sometimes there were big secondaries that happened, and so like the cost basis got reset, right? But in general, it's like a good sort of like metric to think about, at least when you're looking at these FDVs.
Very interesting. And then, so then, if you guys are so bullish on the private markets, why did Jason from Blockworks just tweet that he thinks ICOs are better than private markets in today's world, considering just like kind of how those go down after a conversation with you?
Yeah. Yeah, he literally tweeted that like 3 minutes after we finished our call. Well, I think that like the reason we're bullish on private markets right now is sort of like the same reason as why like ICOs make sense at a very simple level. And this is like oversimplified, but there's maybe for the best projects, there's maybe like 50 funds that have access to the best projects at the private round time, right? Like projects want to raise from tier 1 funds, and there's only a few of those, and then there's like a few more tier 2 funds, and then a few more like tier 3 funds and angels. And then once you go to the public market stage, there's millions of investors, like tens of millions across all the centralized exchanges, right? And so there's naturally just like an arbitrage there where you have these tokens that privately only a few people can bid on them, and then suddenly in public a lot of people can bid on them. And so there's been a lot of money to be made in venture. Like ironically, like the SEC clamping down on ICOs just made it so that they just sort of created which is what regulation tends to do, right? But they just created a moat around venture investors who now have like sole access to these private deals and can basically capture the entire arb of projects going public, right? And like ICOs had a lot of issues. Yeah, I think there's issues with ICOs and issues with the status quo now. Like ICOs, I think the biggest issue is the same one as like launchpads now, which is just like adverse selection. Like the best projects want to raise from tier 1 VCs, and then the tier below that wants to raise from tier 2 VCs. And then if you can't raise from either of those, you go to the public. That's generally like how it works right now in practice, right? There's like few exceptions to that, projects that have like very strong ideological views on how they want to raise and stuff like this, or like, founders that are already rich. But in general, that's how it works, which means that the public just gets like it's the Hasaka meme of the birds getting shit on. You know what I mean? Like there's the bird at the top, and then you're like the public sitting there with like a load of shit on their heads from like all the birds to the top of the thing. And so that,
dude, I'm seeing it like I'm seeing it day in and day out. Like I've gotten some pretty good access to like some quality like modular and roll up angel deals that I'm like, okay, this is a definite yes for me for the roll up. Like we're in on this because like this is something that like this they're not doing a KOL round, and then I get like the KOL round deals that I'm like, dude, like these are like you're just going down a list that somebody gave you and just sending DMs to everybody for this. And I'm just like, you can quickly identify kind of like the differentials. And, I'm also quite bullish on the privates. I've seen like anything under like 50 to 80 FDV right now has been like in infra or in modular or rollups is like instantly like really good, especially if it's a good team. And then like interop under 100, there's been a bunch. Like I've gotten into some really, and I'm quite new to this, right? I mean, I've been in crypto since like 2017, like DeFi summer, all that jazz. But this time around, really kind of like backing teams and like, yeah, I think the state now is still really good. But my current thesis is like, and I've been like hammering them for the last 3 to 4 months. But I'm thinking about like kind of pulling off the gas and focusing more on liquid over the next 2 to 3 months. I'm curious, like, what your thoughts are as like your proportional focus and like liquidity. Are you always investing in private, or as like the bull rages, is it like you focus more on liquid because there's way better short-term returns? Kind of like help me think about how I should manage liquidity as well as other angels and funds out there in the different kind of sectors of the market or stages of the market.
For sure. Yeah. To be honest, we don't think too much about that in terms of buying. I think it's more so because with venture you don't really have a choice actually of when you know what I mean. You're like you kind of like you want to be counter cyclical, but in venture it's just like quite tough because people go out to raise when markets are bullish, because they can raise at higher valuations. And when markets are bearish, in general, if they have money, they're gonna delay the raising as much as possible, right? So we did a lot of investments over the last year and a half, like during the bear market. I think we deployed like a lot of good deals, but we're still like deploying it at maybe even a faster clip now because there's just more deals. So you end up not being too counter cyclical, which is annoying, but it's just like I think the reality of venture. And then in terms of like for us, we do look at liquid stuff and like especially like OTC rounds. Like we did the Lido OTC round, back in the day in like whenever it was 2020 or something, and the same with Solana and AVAX. But in general, we're more focused on private markets, and we're taking like a very long-term approach in terms of backing teams that we think are building stuff that's going to be important, like 5+ years from now. And so we don't really think too much about that. Like we all have PAs and we're all invested in the liquid stuff in PAs, but I'd say the majority of our focus is definitely on the private rounds, and I do think like that's where, I mean, even at our scale is reasonable. It's not like mega fund scale. But, yeah, even at our scale, I still think private deals are the best like risk return if you have access, especially if you have access, right? And like we have really good deal
Seriously,
flow from like
I like it. You think that risk to reward profile across the span of like, and I've probably done like 20 to 30 now with my co-founder. You
Mhm.
think that risk to reward profile outweighs anything else in crypto effectively?
Yeah, I do think so. Like I don't know. I think crypto venture is like an asset class that's so insanely good and like no one really understands it. I think in the future there'll be like I'm sure Harvard Business School case studies about this just because
How did we
you
let them
basically
get away with this?
yeah, it's like it's just you have like early stage returns with like public market liquidity, you know, and it just changes the game in terms of what you can invest in because like normally for a venture investor you have this thing where you only really get liquidity on your investment if it's an IPO or an exit, right? And so you have to only invest in things that can lead to that outcome. And like there's the set of companies that can lead to that outcome is not a perfect overlap with all good companies. You know, there's a lot of really good projects, really good companies that just aren't like made for an exit or an IPO. And if they aren't, a venture investor can't invest in it. Whereas as a crypto investor, you can like you the whole sort of like you know if you have something that's like as a venture investor, you can basically do things that are like 1,000x with like a 2% probability of success. As a crypto investor, you can do everything from like you know a 5x with an 80% probability. You know what I mean? You can take like the whole return probability spectrum, and then at the same time, you have like the ability to de-risk at various stages. Where you know, like I guess the best example of this is like if you're an FTX equity investor versus an FTT holder, right? In one case, you're like that's like a really good example, right? Because in one case, you literally just you had like a I don't know, like 1,000x on paper. Like this thing was worth 24 bill, whatever he raised his last round at 20 bill. But you went to zero, and unless you sold on secondaries, you never saw any profit. Whereas as an FTT holder, like you had the ability to de-risk all the way through, and even while it was going down, and even like now, right, it's still trading as a meme token at like 400 million market cap. You know,
Yeah, people are still getting unlocks and they can still sell.
yeah, exactly. So it's just like a completely different risk profile. Like even you know something like
So you don't
Theranos, where
ever
all the
do
investors
equity
were up.
deals,
We do
just
equity
safe and
deals.
token or just SAFT?
We do equity deals, but the bar is like super high because for us we're giving up on. But there's some things that just like aren't meant to be tokens. Like it's just very hard to. We don't, there's no point shoving a token into something where it doesn't make sense. But like, so we do equity deals, but it's like our bar is very high, where it's like, okay, we're giving up the liquidity premium, and so we have to be like really sure it makes sense, like a founder that we really want to back for a long time, and we have to think there's a possible like liquidity that makes sense. But yeah, we definitely have a preference, a strong preference for token deals.
Yeah, it makes sense. It seems like equity in crypto is not really worth a ton. Is the play with equity though in those cases, is it just to exit at the next Series A, at Series B? Like, is that kind of like the idea, or at a big exit? Like, is that kind of your strategy with equity plays?
Generally, with equity plays, yeah, we're in for the ride, right? So, I mean, we probably won't look to sell. I mean, obviously, it's always a individual decision whether selling secondaries and stuff. But in general, with stuff we invest in, we're in for the ride, and especially with equity stuff. So you have to think that there's going to be an IPO or an exit down the line. It's also different, I think, because we have our own capital. With some funds, your business model is managing a fund, right? And like a lot of them, you're making most of your money on management fees. And so if you have like an equity deal at a low valuation with a founder that you know is really good at raising money and they're going to keep raising at higher valuations, you can like mark up your fund and then raise another fund based on it and make more management fees, right? And that's like your how you're optimizing your business model. Whereas for us, we don't make money on management fees, we make money on performance, and so we need the capital back at some point. Like other people investing in it doesn't really like do much for us. Like marking up the fund doesn't really do much for us. Like we actually need something that can eventually return the capital back. So it kind of changes also how we end up like looking at deals and investing.
Find myself in like your shoes years ago with my co-founder. Our check sizes are much smaller, but just slowly aping and adding to our stacks, and it's quite fun actually. look at pitch
Yeah.
decks and to like go through the process and try to like negotiate a better vest or like, you know, do some terms and just different things. But yeah, it's gotten a little like a little less flexible than what it was in like the Q2 to Q4 of last year. It was like best deals, great FTVs, flexible. Now it's like,
Yeah.
all right, you're either in or you're out. Like, come on. And I'm like, all
Yeah,
right,
it's bull
we're in.
market. Bull market's back. Yeah.
You think it's back already?
Oh, for sure. Yeah. I think it's been back for a little bit, but yeah, for sure.
Yeah. So I'm not sure whether I missed it because I had some troubles with my camera. So did you tell about the like platform for fundraising you're building in Delphi?
Didn't go into it too much, but yeah, we talked about a little bit like why it needs to exist, and then yeah, I think how you solve so maybe like how you solve the problems, right? Um, what's the best place to start? I mean, we talked about like how ICOs, why ICOs are good, and also the flaws with ICOs, right? Which I think are this adverse selection problem that you tend to have the worst projects do ICOs because the best ones don't want to deal with that or the risks, and they want to raise from VCs. And then the second problem is just like accountability, right? Like you had a bunch of ICOs, not to shit on them specifically because there's a lot, but like Golem, I think recently announced their like alpha. They launched their alpha, and they raised in 2017. You know what I mean? Like that's a 7 years to an alpha product, and like a lot of these foundations have like 9 figures of ETH in them that they just raised without ever shipping a product, and they're going to live off that for the rest of their lives, you know, and probably their families will too. Okay, so the family business now is the Swiss Foundation holding ETH, you know, that people, and so like you really do want some accountability measures in there, and to for investors to be able to like recover funds in the case that the team isn't shipping and things like this. So I think that's also part of it. And then the adverse selection, doing it in a compliant way. And so we're leveraging some like new regulations that actually allow you to do ICOs in a compliant way, because that's the only way to get high quality teams, right? Because when you have an uncompliant launchpad, like you're not the one taking the regulatory risk, it's the projects, right? And so naturally, the worst projects are willing to take those risks. The best ones aren't, you know? They can raise privately. Why would they take the risk of an enforcement action, which will kill their project? So part of it is doing it compliantly, having a good legal strategy, which we worked with our general counsel, Gabe Shapiro, to like craft something we're really confident in. And then I think the other side of it is just like aggregating on and off chain reputation to help projects find the most value add investors, right? The most value add people. Because like, think about it, the public sale is like the extreme end. You let anyone invest in your project, right? And if like your first 10 employees make your company culture, your first 100 community members make your project's culture, right? And if it's all like when moon boys, it's not going to be a great culture. And what happens when you have a pure public sale? You know, economic theory tends to say that like, oh, the people that will value it the most will pay for it. But actually, it's like when valuations get stupid, only stupid people buy them. You know, and so you end up with like your stupidest sort of like community members, and that's not what you want. And so I think you want like something in the middle where you can have like a sale that's you should be able to choose everyone who participates in your sale, right? And they should have like a profile with aggregated on and off chain reputation, like things they've participated in, reviews from other founders, their Twitter score, their DGen score, whatever other metrics you can aggregate, and then you should be able to choose who participates. And then we also want to go into like the early rounds, like the tokenized SAFT standard we're building with Gabe Shapiro as well. So the idea is just to own the entire sort of fundraising life cycle and really like and create like a social sort of experience around it, backed by this like reputation. Because yeah, like you said with the angel rounds, right? There are projects now. Maybe I won't mention names, but there are many projects now raising VC rounds at like X val, and then they'll raise angel rounds at the same time at 0.5x val, right? And like
I know exactly which one you're talking about.
yeah. I mean, and I think that's fine. Like, I think it's totally fine. And what it's an admission of is just that there's some like you're trying to optimize for value add per dollar of capital invested, right? If capital is abundant, if you have excess capital, like the ones to participate in your round, you're optimizing for how can I get the most value per dollar of capital in the round, right? And so there's some like on one end of the spectrum, you have like an angel investor who maybe he's a really good builder. He doesn't have much money, and he's doing like a very small ticket, like 20K, but for him it's a lot of money, and so you're actually going to get a lot of their time. A mega fund, which maybe has like 100 investments and like 3 partners, and you're getting like 1/100th of their time, plus everything else they have to do for a giant ticket. And so what you really want to do is like help people design these rounds to maximize like the value add per dollar of capital. And I think that can definitely be like improved a lot. And to me, it's clear that it's a thing.
Yeah,
If that
are
makes
you
sense.
bullish on like these as part of that thesis for founders trying to get the most value per dollar? I think that's why like small like our small checks with our education and media company very in modular roll ups they really like it, pump our bags, blah blah blah, but it's more than that. It's just kind of like BD, all these different types of things. And then similarly you've got like these investment DAOs, like these angel DAOs that like usually get like 200 to 300K allocations. What are your thoughts on these? Like, have you participated in these before? Or have you seen any good results from them? Do you know if they work? Like, I've been getting some like, interest of like joining and like participating, but I'm like, I don't know if I want to share my check with these guys. Like, I'm not the one signing the SAF. I have some agreement. I just have to trust their back end. Like, how does that like? What's been your experience with like these angel investment DAOs?
Yeah, I haven't like we looked at them back in the day. What's the big one? And there's like an NFT one as well. I forget
Like
the name
Meta
now.
Cartel maybe was like one of the
Yeah,
OGs.
Metacartel Ventures, and yeah, there's a few of them. I think some of them have done pretty well. I'm not aware of like the returns and stuff. I do think a DAO model for investment is kind of tough. Like we actually have like, I mean, when we were raising our fund, there was like 7 of us co-founders, and all 7 of us were on the investment committee, and everyone told us like that wasn't going to work. Like you need one decision maker or whatever, and it actually worked really well for us. Like we really had to convince everyone, or at least like a plurality of people, and we all respected each other's opinions, so it worked really well. But you still have to have, it's still like a relatively small group. Like I think these decisions by like huge committees don't really work, and especially like you don't know what other interests people have and things like this. I do think, yeah, I don't know. I think it's tough. Like we do have like a scout model, which I think a lot of funds have, where you can kind of bring deals to the fund, and then if the fund invests in them, you get like some percentage of carry, right? So as an angel, maybe you've taken your max angel allocation that you can take, and you can like kind of double dip by also getting a fund to ape, and then getting a percentage of carry. I think that model makes a lot of sense, and in some sense, it's a DAO, right? You're like tapping into a lot of external capital that can do this. I haven't seen an on-chain model that, yeah, but I honestly haven't looked into it enough to shit on it. So, but I haven't seen one that I was really excited about.
Gotcha. Yeah, one of my
I think
favorite
we did Seed
VCs.
Club. Seed Club was the one he did. I think that
Okay.
one's actually performed really well. Yeah, we invested into that with the fund.
Yeah, one of my favorite VCs got started doing exactly what you just said, and something that I've been trying to do because for people like me who's like the check sizes aren't that big, but what I do have access to is like a ton of people that are raising like either angel rounds or like private rounds at good vals. It's like the upside potential of like doing these carry deals with VCs is like pretty, yeah, it's pretty, there's not many other like levers that you can pull with your time that equate to that amount of upside, at least in
Yeah,
the potential energy.
absolutely. Yeah, especially if you have like a good VC whose brand name is definitely going to get them in, and they have like good size, and also like deals where the val is maybe like higher than where you want to like deploy a lot of capital into. You can kind of like size up through a VC. I think it makes a lot of sense, but for both sides actually.
Yeah, and from the founder perspective, what do you think is the best way to raise funds right now in crypto?
Yeah, I mean, I think right now the meta is basically you raise funds privately from VCs. You do like a series of rounds, and then normally like right before you launch your token, you're doing like a big growth round at some valuation, which is like meaningfully lower than where you think the token's going to launch to give like investors enough kind of juice. And then you launch your token through some kind of like airdrop to distribute the token. And I think airdrops are a function of ICOs not being legal. Like I don't think people would be just dropping 15% of their supply to randomers if you could do ICOs to distribute your token. And so I think like where ICOs would come in would be I think you wouldn't do the private raise, instead, and you would reduce the amount that goes in an airdrop. I still think airdrops are valuable for distribution and stuff, and you would just like do sort of an ICO instead. Um, and I think for some projects you can even go. It sort of depends how long it takes to build. For some, I think you can even do that earlier, and like tap into a community to help you like build your project. But yeah, I really see it as like one of crypto's killer apps is like capital formation, right? It's such like people coming together from all over the world, pooling capital to do some stuff together. Um, and there's a lot. ICOs were a good example of that. Constitution DAO is another really cool example of that, right? Like a bunch of DGens came together to try and buy the Constitution, like, and I think there's going to be more and more examples of that. And to me, like, this is a primitive that needs to exist to make this more efficient and more scalable.
When you are looking at these and on the kind of note of founders raising, do you have an ideal vesting that makes sense for you that you can kind of tell? I've kind of noticed that like these like super legit potential like home runs, they tend to have like 1 year cliff, 3 year vest, or 1 year cliff, 2 year vest. It's never short term. I always kind of get turned off when I see like 18-month linear or something. I'm like, wow, great, I can get my money quick, but like, what's your thoughts on like when you see vesting schedules with regards to like perhaps the question is what's your experience between returns profiles and vesting schedules, like what's the correlation?
Yeah, I definitely think short term. Like, there's many different ways to skin the cat based on like the project, what they're doing, what it looks like. Um, like between fair launches and then the really long vests. In general, most projects will take a while to execute on, and so you need like long vesting schedules for everyone involved. I think are like really important, and I think like most projects will take longer than people think. I think realistically, it's going to be like a 5 to 10 year journey to success. Obviously, there are in crypto that can accelerate much faster in terms of token price, but like adoption, I think is a longer journey. And so I do think I think short term vesting schedules. I think you're right to be suspicious of them. Basically, uh, it just shows that these people aren't there. There's very little you can achieve in 18 months with a startup. Like it's just gonna all the returns are far in the future, and they compound like far in the future. So it's definitely right to be suspicious of that. I think.
I mean, it just screams kind of like short-term thinking.
Yeah, there's a lot of short term thinking in this in every industry, but I guess especially crypto. But really, like all the returns are in the long term in our experience. Like, and it's like never worth sacrificing your reputation or like capital on like short term opportunities when you could be and yeah, and especially because I think there are so few people that are like very long term focused that it's easy to find each other, and that's where like what all the really high quality projects come from is like a bunch of people who are long term focused, like building this stuff together. Yeah.
So I know it's case by case dependent, but like Celestia, Avalanche, some of these big wins you had in the private markets, like are you guys wait like do you guys tend to wait until full vest and then hold longer? Do you tend to like exit in tranches? Like what's your exit strategy when it comes to these like 3 to 4 year unlocks?
Yeah. It's very like case by case, honestly. Um yeah, like it's hard to have a general a general if the project's going well and like executing against you're always looking at like where it's trading, your opportunity cost of capital, and then how they're executing, right, versus like both where they're trading and where you expected them to be. um and so it's like hard to have general guidelines of it. There's been some positions that we were like up a lot on that we like didn't sell a single dollar for, and still haven't sold, like from kind of seed, and then others that we disagreed with the team or didn't think they were executing the right way, where we sold earlier. But it's definitely like very much case by case.
Yeah. So for you guys, is a lot of your thought process like, oh, can I get out of this like with liquidity? Because you guys are going in with size, like, like based on your like. I guess what I'm trying to ask is, you have 10 bets in front of you. How do you position allocations with conviction? Is it just on conviction? Is it on intuition? Is it on founder? Is it on is there going to be liquidity to exit? Like what are your like segments of thought when
Mhm.
you're allocating size, and what would make you allocate 1 to 500, 1 to 1?
Yeah. It's definitely, we definitely don't think about like whether or not there will be liquidity to, we just think that's like a function of like, we think much more about whether the project, we think a lot about team and founders, and there's like a bunch of different partners in the fund. So I'd say we all have slightly different like algorithms for what we look for and what we like to invest in. And it's also adjusted over time, right? We've been doing this for like, I guess like 5 years now. And so we've learned a lot doing it. Like in the beginning, it was just us like learning on the go and making mistakes and kind of paying for them ourselves. And we've learned a lot from that. Personally, the thing I index on the hardest is really the team, um, because almost everything is execution rather than the idea or the market or anything else. And so, um, like that's the thing that like there's some teams where I wouldn't even care what they were doing. I would probably like invest in them kind of without knowing what they're going to build, because I just trust the team, and I'm going to be very confident to back them. And there's like a few examples, right, that like that in our portfolio where I don't really like, obviously you go and look at what they're building and like ask them questions and stuff like that, also because it's a way of judging the team, right? Like actually figuring out like what they're building and why. But that's my highest conviction. And then the second is just sort of like the market, and like the moat and ability to capture value. Like I think we think about that a lot more than maybe many other funds. It's definitely cost us some opportunities as well. I don't know, like 8 million or something, like the seed, whatever it was. And like we've passed on a few things like that where we didn't see a clear way to monetize, like the classic sort of mid curve take. But we definitely do think about that quite a lot as well, like the market size and like the ability to actually like capture value. Because yeah, I think there's a lot of things that are big markets, but where the winner doesn't have like an easy path to capturing a lot of value. I would say though that we've learned to not over-index on that over time. Like I'd say in fund one, yeah, we just shifted to the bit
Just
to the
ape,
left of the
bro.
curve. Yeah, exactly. We just shifted a bit to the curve. Like when you have a really good team tackling a big market, like the value capture, like no one knew that Facebook was going to be able to do these like hyper targeted advertising because they know everything about you, right? When they invested, and there's loads of examples like that, and throughout like technology history, and definitely like in crypto too, right? I mean, if you told me that Uniswap would be able to charge like 15 bips just on their front end, and people would just keep using it, I would never believe you. You know, there's like all sorts of like value capture is products are very sticky, much stickier than you think, like good products. So we think more, yeah, we try and like steer a bit, be careful with that basically. Yeah. And I also think that in crypto, there's like, it's possible. I don't know. It's like a crazy sort of idea, but you can have, I think it's possible to have something that generates no cash flows ever that is still extremely valuable. Like I think like governing something can be extremely valuable. And again, this is something we disagree with, like even within the partners. Like some people are overweight this more than others, but you can think of something example, right? Like a lighthouse. Like a lighthouse is like it's the canonical like economics public good example, right? Like no fisherman. It's impossible to enact a toll for a lighthouse, but it clearly benefits a bunch of other people's cash flows, right? And so if you had to decide, the decision of where to place a lighthouse is clearly extremely valuable because it affects a lot of other people's cash flows, even if the lighthouse itself doesn't make money. And I think there's a lot of examples of like things like that in crypto too, or things people are trying to make like that. Like Metaplex on Solana is an interesting example. And again, we passed on that one, but it's like an NFT standard that's actually governed by a community, right? And can be upgraded. They can add a fee theoretically at some point. But like there's all Solana NFT projects like rely on this standard. So clear, and the market is clearly like assigning value to the Metaplex token, right? Even though there's no cash flows, and there's also questions whether they'd ever be able to charge like cash flows, right? Another example might be like Gnosis Safe, right? Like, do they have like they also have a token. It's actually not transferable right now, so it doesn't have a price. But I think it would trade. It's trading pretty high on secondary markets. They don't charge a fee, but clearly they have the ability to charge a fee if they wanted to. I would definitely just use I wouldn't use the bootleg fork version. I would just use the normal version and pay the fee, right? And so I think we've sort of tried to be, but then at the same time, there's business models that are inherently extremely profitable, right? Like exchanges are just like inherently extremely profitable, and that does matter too, in a way that like, you know, like Lido is never going to be as profitable as the winning exchange, like because you're charging bips on AUM, right? Like you take 10% of staking on AUM, whereas an exchange is like this extremely high velocity use case, and it's always going to be more profitable. And so you need to like valuations need to kind of reflect that too. Yeah, so that's a long-winded
Yep.
answer.
No, I appreciate the deep dive into more of like the thought process about the revenue generation. But I'd like to double click on the first point about the founders. What do you look for in founders, and what are some of like the top questions that you ask founders? And even what are the answers that you're looking for?
Mhm. Yeah, I actually did a presentation about this at some point to the ventures team. I was gonna see if I could
Damn,
find
I would
it.
love to get some hands on that thing. That's the alpha right there.
Yeah, absolutely. I'd say that the main thing you want is, I mean, you need someone that's like intelligent and all those things, but like the main thing you want is someone that's extremely gritty. Like you want because there's really nothing harder than doing a startup, I think. And I mean, like you could be a Navy SEAL and all this stuff. There's definitely things that are harder, but like doing a startup is, Elon Musk talks about like chewing glass every day, right? Chewing like day after day, and that is what it's like. There's going to be like many moments where people want to quit, and so fundamentally, you need to be like super resilient, and you can't really ask someone like, "Are you resilient?" Because everyone's going to say yes. So the only way to really find if they're resilient is to look at their past and see if there's like times that they showed resilience, right, and that they showed grit. Um, and like one way that I like to look at it, which also actually is an important is another important trait in a founder. Like it sort of shows that another important trait in a founder is someone that's got really good at something that isn't like a mainstream thing that has like a clear roadmap to get good at. So like for instance, for someone that was really good at university and then like went to McKinsey and stuff like that, those people are impressive, but that's like the mainstream. Like you had a set of rules that you had to compete at, and you were very good at competing in those sets of rules, right? Whereas if you became like really good at League of Legends, like a top player at League of Legends, you had to like find a way to do that. You had to like go read forum posts, you had to like watch streams, you had to practice, you had to start a guild, and that is much more. That translates much better to being a founder because it's much more like what starting a company is like, right? Like starting a company, there's no like test with a syllabus that you can study for. It's like very much you need to find your way to success, right? And that's much more like someone that's really good at chess or they got really good at some random hobby. Those are like very good backgrounds for a founder because they had to have been very resilient to do that. They had to be thinking outside the box and be someone that doesn't go down the traditional path, which is generally what you need in a crypto founder. Um, so that's really important. And then I do place a lot of value on like references as well. Like the people you want to back are people that if anyone worked with them, they were like this person's like an absolute beast. Like they're the best person I ever worked with, right? And we all have people like that we've worked with before that were like shit, like that guy was a killer. I'd love to invest in that person, like have a share of what they do next. And you really want the people that you're investing in to have made that impression on someone before, right? And so like the reference checking is really important, especially if it's like a reference from someone you trust, because that's really what you want. You're looking for like extraordinary people, and extraordinary people should have a track record of doing extraordinary things, and you should either be able to see it in their track record or find people that can say, yeah, this person was amazing, So like, yeah, I think and obviously talking to them is super important too. Um, I think over time I've learned to like try not to over index on my impression of them because some people are excellent presenters and some people are worse presenters, and also you jive with some people more than others, and like that is important because like you need to work with this person. You don't want to invest in an asshole, but at the same time you don't want to miss good opportunities because you're culturally personal thing that you have that you don't, you know what I mean? Hang up that you have that it reminds you of your dad or something, I don't know, and and you don't invest in them and you end up missing a big opportunity. So yeah, I'd say the biggest thing is just like you're looking for an extraordinary person, basically, and so that they should have a track record of extraordinary things, and people that are willing that vouch for that.
I have
Yeah.
to be honest, I have so many questions, so many more questions. I think we are running out of time. Okay, maybe last question. So can you we were talking more about your venture arm today. Can you tell a little bit about your accelerator incubator? What stage it is right now? Accelerator about a year ago on Cosmos. What do you do now?
Yeah, we kind of don't really do the acceleration thing anymore. We tried it, and I think what we really like to do at Labs is like go really deep in the weeds on like a few projects and really help them succeed and build them out ourselves. Like we're basically founders at the beginning, and then over time we try and like extricate ourselves from the projects and then like have founders come in and take the mantle. And it's very hard to do that as a factory model, doing like a cohort of 8 every 6 months. It's just not like, it doesn't really work for us. And the accelerator just ends up being like a little bit like Groundhog Day. You get like you're reliving the first 6 months of a project's life over and over again, and you're like helping them raise, and then as things start to get interesting, you're like, you already have your investment, you have your equity, you're incentivized to go on to the next cohort, right? And you do the same thing again. And for us, like, I think that's very important. Like, it's very important that those exist. It's valuable, but it's not really what we like to do or what we're good at. So we're more focused on like taking opinionated bets on things that we think are important, and then really like going hands-on and deeply like trying to build them. And so like that's really the model that we're working with at Labs right now.
Okay.
So yeah, does that answer your question?
Yeah. If I don't know if I'm a founder, is it possible to join Labs, to be incubated by you, or you mostly build stuff by your own right now?
We're always looking for talented founders. Like, we're always on the lookout. So like that's the big thing that the hackathons are useful for. We get to work very closely with a bunch of people and actually find talented founders. So yeah, we're always open to talented founders, and we're actually like looking for some founder like profiles for some of the projects that we're incubating. So I think if you have an idea, and I mean, definitely if you have a good idea and you're a good founder, like, reach out. It's just for Labs, it's the sweet spot, because like if you're a good founder with a good idea, we could just like invest in you, right? For Labs, we need to find the sweet spot of like an idea that is early enough stage, and like where we can come in and add a lot of value. Um, and so it's generally like a bit of a different model, if that makes sense.
Yeah.
Like,
Do
where
do hackathons work for you in terms of finding good founders?
yeah, I think hackathons are not great for finding for like good projects coming out of them. Like, it's hard to build a good project that fast, but it's very good for identifying talent, because you get to work or watch people work and work closely with them for a period of time. And so that's like where we've found a lot of our best talent has been at hackathons and other events like that. So we definitely love doing them for that reason. But yeah, it's generally not the project that they worked on in the hackathon, that succeeds.
Yeah, I understand. Super interesting.
Yeah.
I think we kind of need to wrap up. Thanks a lot for joining. Always super inspiring to talk to you. You're so bullish on a lot of crypto narratives and bullish on crypto in general. So last time we talked, I was super inspired after that. So yeah, thanks again. Thanks for that again. Thank you for your time.
Thanks for having me. And yeah, cheers. Good to meet you guys. Good to meet you, Andy. I mean,
Pleasure.